It's historic to see the rapid rise we've seen in rates, but the question is just how high we can go from here.
Well, look, the 5% priced in is important to understand for equity investors, because when you think about this rates move, what it means is that a lot of what's happened to the indices this year is really just about rates going higher. And so we have to be focused now on companies that start reporting lower earnings going forward, because that could be another leg down, particularly in tech, where we think the overvaluation remains.
For for equity investors who are trying to understand what the bond market is telling them, what is the message that we're hearing right now, especially in the shorter part of the curve with the 2-year at 4.6%? I mean, that's a huge move.
Yeah, the bond market is telling us that the Fed is serious about using its powers to hike rates to try and trim inflation, and that while the inflation expectations over the longer term remain relatively contained, there's no immediate end in sight, and that's helping to drive these rates higher.
So how should investors play this? What specific sectors do you think still have the opportunity to move higher, to outperform in an environment where rates seem to be only going higher, at least for the near term?
Right. So there's a couple elements to this. When I talk to investors around the world, I think there is a lot of negative sentiment around a lot of the geopolitical events, and that could set us up for something of a bounce here. So one of the things that we've been doing is looking at option strategies to kind of hedge a little bit of the downside, but be prepared if we do get a bounce on what is a pretty good earnings season so far. But then when you look out from there, the risk reward around earnings not coming through, say, in following quarters, and this pressure from the higher rates means that you really have to be selective. And for us, that means continuing to focus on value, where we've seen that value stocks can really outperform growth stocks when you have this kind of high inflation. So that's where I would start.
Biggest pieces of economic data on your radar, Mark, going into next week? I guess it's the jobs report.
Yeah, the jobs is so important. I mean, ultimately, the Fed is saying inflation first, jobs second. And of course, as long as those jobs numbers remain strong, it's probably just going to push out any kind of Fed pivot further. And that makes it a little risky for equity investors.
Did you see comments from the Philadelphia president of the Fed, Patrick Harker, who said the unemployment rate he sees the maximum it could reach would be 4.5%? Does that line up with your estimates as well, Mark?
I think the most important thing to think about here is the Fed, like other institutions, like we saw in the financial crisis, their number one priority is to protect their institution. And for the Fed, that means taming inflation. And so really the talk about the second part of their mandate, which is managing employment, that is really secondary at this point. So, we can guess about inflation, but we know what they're going to, we can guess about employment, but we know what they're going to do about inflation.
Yeah, that jobs report comes out November 4th, so 2 weeks from today. What's your S&P 500 target, Mark? With all of this that you've just shared with us, inflation being persistently high, the idea that rates have to continue to move higher, where do you see the stock market ending by December 31st?
I think when you look out longer term, say next summer, markets around here make sense. I think what we're looking for is if we get opportunities to start buying around 3,300, that begins to get really interesting for us.